I'm Lynette Zang, Chief Market Analyst here at ITM Trading, a full-service physical gold and silver dealer specializing in custom strategies. And you know what? Once you really know the truth and you have your strategy in place, one thing I have just learned over and over again in all the years that I've been doing this, formulas are so much smarter than I am. And this is your opportunity. If you see the patterns, you recognize these repeatable patterns, you can know the truth. Even if you don't know the details, I don't know that that's really all that relevant, but you got to know the truth. So you make choices that support your best interest because they're cheerleaders to keep you in the system. Look at this. The bear market has nearly been erased fewer than 20 months after it began. Whoop-de-doo. Really? Tell me really what's gotten better? Nothing. In fact, a lot of things have gotten a whole lot worse. Don't worry, because key U.S. inflation and wage measures cool and boost for a soft landing. So aren't we hearing all the time now, well, there might just not be a recession, even though all the technicals are saying there's going to be a recession. Yeah, maybe it'll be a soft landing, which means nobody will notice. Well, hey, look, I can't control these things, but I can tell you personally, it's a lot of hooey. And the longer they manage to somehow miraculously postpone the inevitable, the worse that an inevitable collapse will be. And really, I've got to tell you, I don't want you to be stuck in a paradigm that does not serve you well. And so I want you to really ask yourself, do you believe these guys? Because I know better. I don't believe them. But hey, traders, because that's what it's all about. Everything has been turned into a commodity. Traders are risking it all on bets that the market boom will last. But for how long? For a day, a week, a month? Do I think that it's possible that all of a sudden we could wake up tomorrow morning at 8:35 and the system could collapse? Well, weren't you there in 2008? Because we had all the signs leading up to something very nasty was coming. But most people absolutely ignored them until that September 2008 when Lehman collapsed. They saw nothing, even though we saw the signs coming up to it. Traders are just about short-term profit. They're not investors, and they don't give a crap about you or me. The steady expansion of speculative spirits has pushed equity positioning to the highest level since January 2022, and it was already at nosebleed levels then with all that massive amount of free money that the central bank pushed into the system. And so what are they doing? They're allowing themselves to be more vulnerable. I don't want you to be vulnerable. They are being vulnerable. Less demand for tech stock hedges because after all, these markets are never going to go away. They're never going to go down, except we've watched this really. It peaked in 2017, demand for hedges, and it's been declining ever since. Lower and lower highs tells you the direction it's going in. At the same time, a wide array of hedging metrics is showing low demand for downside protection. Vulnerable, vulnerable, vulnerable. Who's going to bail out these guys? You and me, the taxpayer, because what choice do we have if our government chooses to do it, just like they did at SVB Bank, the banking crisis that happened in March? And because everything is so fabulous, and of course, all the banks passed their stress test, Morgan Stanley sells $6.75 billion of debt amid bond rush. And so does JP Morgan, Wells Fargo. I mean, hey, look, let's get this in while the getting is good. You look at the interest rates, but don't you have to stop and kind of ask yourself the question that why are they issuing all these debts with all of this high interest rate unless they think interest rates are going up higher? Why not tap the debt markets now? If this week's bank deals are any indication, investors are hungry for more financial issuance. Morgan Stanley raked up $29 billion in orders for the high-grade deal, according to Bloomberg, blah, blah. Meanwhile, JP Morgan's bond offering on Monday saw a peak book of $17 billion, and Wells Fargo on Tuesday saw demand of more than $21 billion. Goldman Sachs Group, Citigroup Inc., and Bank of America may still add to the bond issuance spree. Happy days are here again. Everybody wants these bonds. But again, I'm thinking, they're only issuing bonds at this level of interest because number one, they can because they're buyers. They want to get you while you got the money. And number two, they must think interest rates are going up, or why wouldn't they do the opposite and wait until lower interest rates to issue these bonds? Just think about that. Well, what's really happening? What is it that you're not really seeing? Because, of course, one of the things I always thought was so interesting when I would read a paper, there would be a story on the front page, and then there'd be a story buried way back on the 15th page that totally goes with that story in the front, but nobody sees it. And this is that kind of thing. Selling debt as deposits leave. So what is that? Hundreds, millions, billions, trillions? Really? Oh no, hundreds, thousands, millions, billions. Thank you. So 78 billion exits the US banking system in 1 week. So they're selling this debt to replace the deposits that are leaving the system. And the deposits are the cheapest source of bank funding. So they went from cheaper sources to more expensive sources. Think about this. But can you also see the fragility in the banking system? Because, is this the start of a run? And with the FedNow and that instant ability to pull your money out? You saw the problems that were created in March when there was a run on those banks. Well, with the issuance of FedNow, that means that the banks are even more fragile to those bank runs. So what are they going to do? Stop you from demanding your money? Well, they can, because if you don't hold it, you don't own it.